All right. Welcome to Clarity Sessions with Bill Fouth, where we cut through the noise and bring you real, practical clarity on money, business, mindset, and everything in between. Now, if you're a mompreneur, a business owner, or someone who's just ready to take more control of your financial life, this is your space. No fluff, no overwhelm, just simple, powerful insights you can actually use. Because let's be real. When you got the right clarity, you make better decisions, and better decisions lead to a whole different life. And so let's get into it. Today's question is,
how should someone handle taxes when selling in multiple states?
the question is how the taxes work if I'm selling products in multiple states. The short answer is wherever you have a physical presence or wherever you're doing some economic activity, you're supposed to pay taxes in that state. So the idea is that, like, this is one of the reasons why Celine Dion and a lot of the big actors want to do their performances in Las Vegas. Because Las Vegas is a state that doesn't have an income tax. So if they earn income in Las Vegas, they only have to pay the federal tax on it, not the state income tax. But if they do concerts all around the country, they have to pay taxes in each one of those states. And baseball players are like that. Every time they do have a game in another state, they got to pay tax on a portion of that income. So the idea is that there's another component of this, is that if you're selling a tangible product that is subject to sales tax, so selling into those different places, then you're supposed to pay sales tax in each one of those places, which is another whole level of compliance. Sometimes if you're doing it through a platform like Etsy or Amazon, they'll do the tax compliance on the sales tax, and they'll give you a 1099 and broken down by state as to how much money you earned in each state. There's a tax compliance issue. I have a lot of clients who do business, in New York, and they do business in other parts of the state. So we do an allocation of how much money was earned. Federally they have to pay on everything, but they may have done some business in Ohio, or may have done they don't have to pay New York State income tax on businesses they did in Ohio. So there's an allocation process that we have to do. So again, it complicates things a little bit, and it's your advantage to do that, because if you pay to the wrong state, or you may end up doing double taxation or triple taxation. One of the things that's good about this is, depending on how you're doing your business, if your merchant account is doing all the sales, that's easy to track, because you get a K1 and you can do a report out of your merchant account as to where the sales were done. If you're doing QuickBooks can do the same thing. It depends on how you collect the money. So again, it's one of those things that we need to shine a light on when we do the tax planning, or we're setting up your entity and seeing how we're going to handle that. And the state where you're earning the income, they're going to want their VIG, or their taxes on the money that you earned.